So if we look at the orange trading system, we do five kinds of analysis on a particular stock: the liquidity analysis, comparative analysis, technical analysis, fundamental, and market. Within fundamental, I look at four factors: EPS growth, sales growth, return on equity, and margins. Now, return on equity, as we all know, that if the return on equity is less than 17%, we say that the stock is fundamentally weak. And if the return on equity is more than 17%, we say that the stock is strong. This is what is written in William O'Neill's book. Now, where does 17% come from? Well, people like William O'Neill have looked at 100 years of stock market history. They looked at leading stocks of the past, and they realized that almost in all of the cases where stocks showed big price advances, their return on equity was at least 17%. So when someone like William O'Neill writes about return on equity in his book, he is not giving his opinion. He is just presenting you the fact. He is just reporting to you the data. He is just explaining to you what he's observing in the market or observed in the market. Okay. So that is where 17% is coming from. Now, we need to understand return on equity uh, slightly better, because if we are using a particular parameter as a stock selection criteria, we better know in detail what we are using, why we are using it, why is it important for the price growth of a particular stock. So if we look at return on equity, see, return on equity is nothing but profit divided by equity. Profit means after tax profit. Equity means the money that is invested by the shareholders in the company. So basically, if I put $100 million into a company and the company makes $10 million profit, that's a return on equity of 10%. So, uh, how much profit am I getting per dollar of equity that I have invested in the business? That is what return on equity talks about. How efficient, how effective is the business? That is what return on equity talks about. Now, there is one problem with this ratio. The problem is the profit is calculated over a certain period. So, for example, the profit is calculated over a 1 year period, but the equity is as on a particular date. Okay. So, let's say I look at equity today, say $100 million, and the profit is $10 million last year. Okay. So, profit is over a period of time, equity is on a particular date. So normally what people do is people take the current profit, whatever they have, current latest annual profit figure. Equity, they take the past 2 years of average. So today's equity and last year's equity, I take an average and that average becomes this denominator. But for this discussion, I want to keep it simple. Let us say it is latest profit divided by latest equity. Let us keep it simple. That is what return on equity is all about. And William O'Neill says that it should be minimum 17%, which means if I am investing $100 million in the business, every year the business should generate at least $17 million for me as the shareholder of the company. Right? That's what this ratio means. Remember one thing that um, he also says that if the return on equity is more than 17%, you don't have to look at the after tax profit margin. In fundamental analysis, we look at four factors: EPS growth, sales growth, return on equity, and margin. If the return on equity is more than 17%, we don't even have to look at the margin. Okay, we can just ignore the margin factor. Why is that so? Why is O'Neill saying that return on equity is more important than margin? I will explain to you how. Okay. See, if you look at this ratio, we can split this ratio. Okay. So, for example, like this. So, this was profit divided by equity, right? If I go back, profit divided by equity, I add two more parameters here: the sales and the assets of the company. So, profit divided by sales, sales divided by assets, assets divided by equity. So sales and sales cancel out, assets and assets cancel out. So you get profit divided by equity. That is how ROE is calculated. By the way, this is called as DuPont analysis. It's very important. Let me explain what this is. It's the same ratio. Basically, this ratio and this ratio are one and the same. But since we have split the ratio into three different categories, let's look at what those categories are. Profit divided by sales is nothing but the after tax margin of the company. So this, what's the margin of the company? What is the net margin of the company? So this is operational efficiency of the company. For every $100 million of sales, how much am I able to retain in terms of profit? So 10%, 15%, 20%, the higher the better. Sales divided by asset, this is called asset turnover. So this is asset efficiency. This is operational efficiency. This is asset efficiency. So if I have assets of $100 million and my sales are $200 million in that particular year, so the asset turnover is two times. I am generating two times the sales compared to my assets. So the higher the turnover, the better it is. Okay. And then assets over equity, this is nothing but leverage. So if let's say the assets are, say for example, $200 million, equity is $100 million. Okay, so that's three times. The assets are three times the equity. So 100 million is the equity. How come assets are 300 million? Because there's 200 million of debt in the company. So this is the leverage. This is the discussion point. Just because the return on equity is high doesn't mean that it's a great company. And by the way, I will explain to you. Let's say there is a company which generates a return on equity of 25%. Another company generates a return on equity of 45%. That doesn't mean that the company that generating 45% return on equity is better than the company that is generating 25% return on equity. It sounds counterintuitive, but when you look at this ratio, you will understand. Let me repeat what I said. One company has ROE of 25%, another company has ROE of 45%. That does not mean that the second company is better than the first company. Although both companies meet our criteria of minimum 17% ROE, although both companies qualify in our system, in our orange trading framework, but that doesn't mean that the 45% company is better than the 25% company because of this ratio, because of this leverage. Okay. So profit divided by sales, this is called operational efficiency of the company. Sales upon equity, sales upon assets, it's called asset turnover. Okay. The asset efficiency of assets to generate sales, asset efficiency, operational efficiency. So this is about cost, how tight we can keep the cost of the company so that the margin remains high. And then this is leverage. The higher the assets compared to the equity, the more is the leverage in the company. Have a look at an example. Okay. So let's say there is a company with 15% profit margin. Sales are two times the assets and assets are two times the equity. So if you multiply all these three, 2 into 2 is 4, 4 into 15 is 60. So 60% is the return on equity. There's another company, okay, 20% margin, sales over assets is two times, assets over equity is one. So basically assets are same as the equity. So there's no debt in the company. Generally, this doesn't happen. Every company will have some small amount of debt. But for simplicity, I have kept it one, saying that the company never incurred any debt. The equity itself is the asset of the company. There is zero loans in the company. Okay. Now have a look at this. One company has ROE of 40%. Another company has ROE of 60%. That doesn't mean that this company is better than 40% company. Why? Because number one, this company has lower profit margin. So operational efficiency of this company is relatively lower than the operational efficiency of this company. Another thing is this company is a leveraged company. The assets are twice that of equity. Here the assets is equal to equity. So if you look at this company, it has no debt and it has a higher profit margin compared to this company. So out of these two, which company is better? Which company has got less financial risk? Which company has got less balance sheet risk? Which company has got less business risk or operational risk? Well, it's this company, right? The 40% company. That is why I said just by looking at the ROE does not tell us which company is better or not. You have to do this kind of analysis, which brings me to the next point. We are traders. Remember, we are not investors. If I do this kind of analysis on every company that I'm looking at, I'm going to be wasting too much of my time. So, simplicity and flexibility is a very important component of my orange trading system. I want to keep it simple. As long as the ROE is more than 17%, I don't want to go deeper. I don't want to go into further detail because I want to keep my system simple. Okay, as a trader, I only want to look at those factors which are crucially important. I want to limit my analysis to certain factors which are very important, and I don't want to get into analysis paralysis. Okay, if I start reading annual report of every company, I will not be able to execute a particular trade. So I have identified which factors are important in each of these departments. The closer a stock is to my particular criteria, the lesser is the risk that I'm incurring. The further away the stock is from my defined criteria, the more risk there is. Okay, as simple as that. And how do I control risk? Two ways. Either I reduce position size or I move my stop loss higher, or I do both. Okay, those are the three ways to control or reduce risk. So, as you can see now, this is for your academic knowledge. Okay, you should understand that if you are using ROE, what it stands for. Okay, why William O'Neill is saying that the if the ROE is more than 17%, don't even look at the margin of the company, because the margin is included in ROE. Okay, the margin, this operational efficiency is included in the ROE ratio. So if the ROE is beyond a certain level, that's good enough. We don't even need to check margin. But imagine a company where the ROE is more than 17%, the margin is at an all-time high, the EPS, annual EPS of the company is at an all-time high. Well, what does that do to your risk? Well, that reduces your risk on that particular position. That is how I look at it. Okay. So I just wanted you to understand properly what return on equity means, why that 17% number is important. And O'Neill also says that if the ROE is less than 17%, go and look at the margin. See, if the ROE is less than 17%, at least we need a company which is generating good margin on the sales that it is generating. ROE less than 17% means we are not getting enough bang for the buck. So, for example, for every $100 million invested, we are getting maybe $12 million. That's a 12% ROE. But if the margin of the company is good enough, okay, the company will have enough cash in hand to invest in future projects. Maybe the ROE will improve in the future, right? That is the reason why he says that if the ROE is less than 17%, you can look at things like after tax margin. But if the ROE is 17% or more, no need to look at after tax margin. Okay. Thank you so much.